Despite plenty of negative headlines, markets have rallied to new record highs in recent sessions. But as we get ready to enter a new quarter, can that run continue? And how should investors be thinking about their asset mix? Joining us now to discuss, Jing Roy, VP, Director, and Portfolio Manager for Asset Allocation with TD Asset Management. Jing, great to have you back on the program.
Thanks for having me.
Let's talk about how we got here. Markets hitting these new highs, nothing but negative headlines if you want to go looking for them. What happened here?
Three things happened. First of all, the market is really being powered higher by AI stocks. So the AI have-nots, on the contrary, unfortunately, are mired in the tariff, uncertainty of the policy, and also elevated borrowing cost. And the second reason is that, outside of AI, we are actually seeing the fallout from the tariff. It's much more contained. Based on U.S. custom data, the effective tariff rate on U.S. imports is only just below 10%. So it's very digestible, especially on the back of very easy financial conditions and fiscal stimulus. And lastly, you've got the recent Fed dovish pivot, and that's adding fuel to the fire.
Fuel to the fire, AI leading the charge. You might ask, has some people asking, are we in a bubble?
That's a very hard question because it's only a bubble if it bursts, and people usually call it after the fact. So in order for it to have a bubble, there has to be plenty of ambiguity, and we actually have plenty of that right now. Think of it, we're trying to price a new technology that's evolving rapidly, and it's very nascent in its adoption and monetization. Maybe, take historical precedents as a share of GDP, the investment in technology and AI is actually exceeding what we experienced during the dot-com boom, and just a smudge below the housing investment during 2007. So that's pretty high. This year, the capex in AI is probably going to be reach $300 billion. To make a reasonable investment, return on that investment, you will require $1.2 trillion of revenue. To put that in context, that's about half of Canadian GDP. And last year, AI-related revenue is about $45 billion. So the expectations are obviously pretty high, but AI is a transformative technology with enormous addressable market. So it's interesting. It's perfectly rational for tech companies to try to outspend each other and vie for dominance, because if you look at it, it's a game of prisoner's dilemma. So the arms race will continue as long as investors are willing to go along.
There was some concern, I think, last week when I sort of mentioned the markets being uncertain about the AI trade. It was only a couple days, then we got stocks bouncing back, but there was a bit of a circular trade right now. I found that a very interesting concept. That first it was like, oh, this is great news that NVIDIA is going to put $100 billion into OpenAI. It's like, wait a minute, they're all just AI plays investing in each other. Is this still part of the phase we're in right now, where we need to move on to the next step beyond that?
Well, you're seeing a bit of a strategic rationale for that financing deal. It is creative and also harkens back to what we know from Nortel vendor financing. So, financing is part of the ingredient of a bubble, but it doesn't necessarily mean it's a bad thing. Ultimately, what's going to pay for this massive investment is productivity gain.
Okay, so we put all that together. People are probably naturally wondering, and the year's going by fast. We're going to put another quarter behind us. We're going to enter the last quarter of the year. Can the market still power ahead for that final quarter?
Well, of course the market can power ahead. Let me give you a bull case. So take S&P 500 index, for example. The bull case is for cyclical sectors to accelerate from this point on the back of easy financial conditions and fiscal stimulus, while the AI stocks grow into their high valuation. In that way, for S&P 500 index, the consensus earnings estimate is around 12%. That means, it has the potential to return 12% in 2026. And on the back of that, if you also have, more Fed cuts being priced in, then you have a bit of multiple expansion, then you can get to mid-teens. Of course, the valuation doesn't leave much room for error. That's why we have to be more attuned to risks. The risk to that outlook is very rapid deterioration in economic growth, or significant downward revision in earnings, and also disappointing productivity gains from AI.
Are those the guideposts that we should be watching for if we're worried about risk? And people are always wondering, okay, when will I know? What are you watching?
Yeah, the market can go up. It doesn't mean it will. So there, so there are three guideposts I'm looking at. First, related to the AI theme, it's really the pace of improvement from foundational models and the pace of adoption of AI and the productivity gains from early adopters. As I said, you really need a productivity gain to justify the AI investment. Second, related to economic growth, I'm looking at a combination of non-farm payroll growth, unemployment rate, and wage growth. You know, a weak non-farm payroll growth does not necessarily mean the economy is weakening, because now the job creation is becoming more constrained by the rapidly shrinking immigrant workforce. Lastly, it's about liquidity. So I'm looking at the Fed rate cut path, Fed's reserve balance, and also the lending standards from the banks. So if there's abundant liquidity in the system, and then the equity market will be less accident prone.
All right, so we take all that together and we start thinking about positioning of a portfolio. What are we thinking there?
It's a classic case of escalator up and elevator shaft down. So it's best to pack a parachute or two. So there are a few ways we can manage the drawdown of equity market while at the same time remain invested. Investing doesn't mean only investing equities. So, you know, there are a couple ways to do that. First of all, table stakes. Please avoid going all in on one theme. So for an investor, you know, who can have a very monolithic portfolio, even though it looks like it's diversified across AI, technology, utilities, industrials, and materials, but it can just be all indexed to one theme. There are other attractive themes we're seeing right now. To give you a few examples, one is cyclical reacceleration and broadening of the market leadership through interest rate sensitive cyclicals. And also we're seeing attractive, you know, structural reform to improve shareholder return in Korea and Japan. And also closer to home, there's the fiscal stimulus to improve productivity in Canada and also in Europe. And of course, I don't want to leave out the hottest trade right now. It's, you know, how to hedge against a captured Fed and a politicized Fed through gold and gold equities. So this is one way, you know, table stakes to be diversified. The second way is you can really dial down the risk by a notch by looking at more stable returns from bonds. So corporate bonds, in fact, are actually yielding 5% for investment grade and 7% for high yield. That's way ahead of inflation and the GIC. And they tend to fall less during market sell-offs. And lastly, you know, if you're more sophisticated investors, then you can look into replacing some part of your cash equities with call options to maintain your upside exposure but limit your maximum loss to the option premium paid. If you're even more adventurous, you can engage in relative value trade where returns are not really associated with the direction of the market.